Good afternoon, and thank you for joining us over the lunch hour for our annual college planning workshop. In honor of 529 Day, May 29th, we'd like to provide an informational webinar on the benefits of utilizing a 529 to save for educational planning and other additional planning needs. Today, Flagship Financial is partnering with the team of John Hancock for our workshop, and presenting today will be Stephen Jagard, who is a 529 specialist and the Northeast Sales Director for John Hancock Investment Management. Stephen has been in the financial services industry for over 6 years and is responsible for driving sales and business development of the John Hancock Freedom 529 plan. In addition to his knowledge of the 529 landscape, Stephen also specializes in more niche topics, including financial aid, estate planning, different strategies around gifting, and also the educational planning as a whole. So without further ado, I'd like to introduce Stephen Jagard, and thank you for joining us today, Steve. We will have open Q&A at the end, so if you'd like to add your question in the chat box, please feel free to do so, and we can make sure that any specific questions to anything regarding college planning, FAFSA planning, the new Secure Act, we can answer any and all questions that come on board. So thank you very much for your time today. And without further ado, I'll turn it over to Steve.
Thank you, Dean and Krista and everyone else on the team. And thank you everyone for joining today. Like Dean said, my name is Stephen Jagard. I am the 529 specialist covering the Northeastern states at John Hancock Investment Management. But today's presentation won't be anything related to the John Hancock Freedom 529 plan. It will be much more focused on really misconceptions around 529 savings plans and maybe other areas that they might impact in a client's financial plan, whether that's a little bit of estate planning or financial aid, and certain regards of a person's plan. With that said, a little bit about my role. I generally partner directly with financial advisors and their teams, and really am a consultant to not only our 529 plan, but the 529 industry as a whole and the education planning industry as a whole. So with that said, I've been in the industry again for about 6 years, and I'm going to keep this presentation pretty educational and very general. So this presentation deck is actually a little bit different because it's kind of set up really as like a true-false questionnaire. So it's a little more engaging in that regard, but for the sake of time, we'll kind of run through that and just go over many of the main topics that each slide is going to go over. So why is college so important, right? I mean, this is a storyline that's been around for a little while now. I think many people here understand the value of a college degree versus not having a college degree. You tend to have more job opportunities over the course of your career. Most people tend to make more money and more earnings, or even start with a higher salary. And people tend to experience less unemployment because they're more likely to retain their jobs and they're a little bit more marketable, so they don't go as long without having a job. Nothing too new there. But unfortunately, college is becoming much more expensive. And this is, of course, across the board with a lot of things in today's society, but education in particular has gone up at a rate that is higher than almost anything you're going to come across when you compare it to, whether it's healthcare or the cost of even housing or cars. To put a number to it, over the past 30 years, it's gone up at about a 5 to 6% clip per year, which is why you see some of these private schools across the country being north of $60,000, $70,000 per year when everything is all said and done and included. And even public schools, you know, the rate might not be 5 to 6%, but it is still increasing in a way that is not affordable for a lot of people. And this makes it much more difficult to pay for education. 70% of families said they're concerned about having enough money, and 82% of parents say it's extremely necessary or very necessary for their child to receive some sort of aid, whether that is federal aid from the government, whether that is scholarships from different schools and universities, And unfortunately, people resorting to taking out student loans, which has become a huge issue in American society. And the student loan debt has just been ballooning. So obviously, I'm a little biased. I always think that should be a last resort. But bottom line is people are looking for more creative ways to help pay for education. But all the more reason why 529 plans have become much more popular over the last 20 years. They're a great investment vehicle for those who are looking to save for many different types of educational institutions, not just colleges and universities. And you get some great tax benefits, including tax deferred growth and money coming out tax-free on a federal and state level if it's used for qualified education expenses. So we'll get a little more in the weeds with that as we go through the presentation. But again, this is kind of a little bit of a back and forth true false setup. I'll show you the example on the first slide for this. And of course, feel free to take notes and throw questions into the Q&A as we go along. But with that said, question one, a 529 savings plan can only be used to save for an in-state school, true or false? And the answer to that one is going to be false. So when it comes to using money from a 529 plan and making sure that it comes out tax-free on a federal and state level, it much more depends on what the money is used towards, and specifically if it falls under the category of qualified education expense. Now, on this slide, you're going to see a list of many of the qualified education expenses that are out there, particularly the most common ones. And a lot of the time, it's really going to be expenses that a college or school directly bills you. Tuition and fees, room and board, books, dining hall plans, food, and even a lot of off-campus housing, international and study abroad programs. There are a lot of things that fall into the category of qualified expense as long as it's tied directly to education. But this list is not all encompassing. So don't look at this as the end all be all. But you'd also be surprised at what 529s do allow money to go towards. So for example, additional needs and expenses of a special needs beneficiary, whether that maybe be tutoring or something along those lines. K through 12 tuition expenses up to 10 grand a year per beneficiary. So if you go to like a private high school, for example, you can pay for tuition using a 529. And something that changed a handful of years ago is you can actually use up to $10,000 to pay off student loans per beneficiary, whether it is private or federal loans. So great thing about 529s, there is a lot of different types of educational expenses that the money can go toward as qualified. On the flip side of this, you also want to watch out for expenses that are not qualified. Now, technically anything that is not qualified is going to be something that's not related to education, whether that's taking money out to buy a new car or use it for maybe a vacation or to buy clothes, something of that nature. Clearly not, directly tied to education expenses. But there are some expenses out there that people might think are related to education and unfortunately are not qualified. So some of the most common ones are up on here on this slide, and I'll add one or two as well. Insurance, sports, or club fees. Basically anything extracurricular is not considered qualified because it's not considered a necessity for the school or to complete a program. Same thing, Greek life dues. If you have a child that's in Greek life, fraternity or sorority, those are not qualified either. Transportation costs, however you get to and from the school, even if the school is far away from home or if it's a school overseas, those are not going to be qualified. Remember, if you repay student loans, $10,000 lifetime limit per beneficiary, not per year, that's per lifetime. And K through 12 non-tuition expenses are not qualified. So for K through 12, that 10 grand again is only for tuition related expenses. One more that I'll add on here that I tend to get asked is things such as tutoring or maybe college Common App application fees and just college prep in general. Those are not going to be qualified, with the exception being when I mentioned last slide, a special needs beneficiary tutoring would be qualified for that. So special needs beneficiaries have a little bit of a different range of the types of education expenses that they can use the money for. It's just a little bit broader. So question two, you're better off sticking with your local state plan, true or false? So basically it's asking, should you almost always go with the local state plan based on the state that you reside in? And the answer to that is it's mostly false. So the reason I don't like this answer is it depends. basically this question talks about what should you look at when choosing between a 529 plan? What are some of the most important factors? Because different 529 plans, of course, have different investment options. They have different benefits that might be suitable for you. So the two main things that people will look at is, one, is there a tax deduction for contributions to the 529 plan? And how much is that going to be? And the second component will be, in most cases, the underlying investment options, the managers, and what the historical performance has been like. And is that something you can hopefully see continue in the future? So, but there are 50 different states out there. Every state has a direct sold plan. There are a lot of states with broker sold plans. So it can be hard to choose and hard to sift through a lot of this, which is why it's a great reason to work with a financial advisor to help you decide which plan is going to make the most sense. Now, for a lot of people listening in, especially if you're a Pennsylvania resident or an Ohio resident for that matter, since it's a neighboring state, you will get a tax deduction for funding any 529 plan, not just the in-state plan. So that's great because you basically can choose any 529 you want. You can pick one with, the best benefits and the best maybe investment performance, or one that you like and understand the most, and you get to the tax deduction either way. So again, great to work with a financial advisor on this who can help you sift through all of this information. Question 3, 529 plans can't be used for adults, true or false? Basically, can an adult be the beneficiary of the 529? And the answer to this is false. Of course, 529 plans can be used for adults. So many people tend to think of 529s as only for individuals who are 0 to 18 years old saving up for a 4-year education. But in reality, there are no age limits to a 529 plan. You could be 75 years old and you might want to go to community college to keep yourself engaged and stimulated as you get older. You can set yourself up as the beneficiary of your own 529 plan. So 529s can be set up for anybody that essentially has a social security number associated with their name. Sometimes people will even save for unborn children, basically putting the 529 in their own name, and then once the child is born, changing beneficiaries to that child so they can kind of get a little bit ahead on saving for that education before the child is actually born. And a great thing about 529s is you can do that because you are allowed to transfer money to another beneficiary who is a current family member of the current beneficiary. So that's a great level of flexibility with 529s. You can move money around within the family very easily. And it's the most common thing that people will do with leftover money in a 529 plan because there are no taxes or penalties associated with that type of move. Question 4, 529 plans are just for traditional 4-year colleges, true or false? If anyone's been paying attention thus far, the answer to that you would know is false. So 529s are great because they can be used for an array of different educational institutions, whether it is junior and community colleges, vocational training and apprenticeship programs, which are becoming much more popular now, given the cost of a traditional 4-year degree. Postgraduate programs, going for your master's, going for a doctorate, those are going to be qualified as well. And to get technical, it's really any educational institution that meets a federal accreditation standard. So all that means is, does this program or school have a federal code associated with it? Pretty much any major 2- and 4-year college and university in the United States will have a code associated with it. You don't even have to look it up. But if you wanted to get technical, or if you were looking up to see if a specific online degree was qualified, or maybe certain international programs and institutions, which many of them are, then you just go on the Department of Education's website or Google search Department of Education, list of federal codes for schools, and you'll see it pop up on one of the first links, and you can just search to see if the school is on there. But again, that's if you want to get technical and you want to be 100% certain. But again, you can use the money also through K through 12 and different vocational schools. So there are a lot of different educational institutions out there that this money can go towards. Question 5, 529 accounts are difficult to maintain and open, true or false? I always thought this was a bit of a funny question because I don't know what the reasoning would be if the answer was true. So thankfully, the answer is false. And when it comes to 529 plans, there are really two ways to go about it, right? You can go directly through a state's website and sign up yourself as a client, or you could work with a financial advisor and utilize what's known as a broker sold 529, which you can only access if you have an advisor sign off on the account and help you manage it. And this is a great benefit for many people because advisors will help you with the investment allocations, understand your goals and the time horizons, make the right investment selections, and really just tailor the account so you can optimize all of the benefits out of a 529 plan that they have. Many people don't take advantage of all the benefits that a lot of 529s have to offer and don't understand the different ways that they can be used. So going in the direct route is one option. But if you are looking for assistance and you really want to make sure you're optimizing everything you can with a 529, going the route of a financial advisor is usually preferred for a lot of people. So in this case, they're not difficult to open and maintain because the advisor would do it for you. But generally speaking, 529s are pretty straightforward. Otherwise, that would be very interesting if they were not. So question 6, high income earners can't contribute to a 529 plan, true or false? So one thing about 529s and a common theme that you'll see come up is just the level of flexibility that they have. So a great thing about 529s is there are really no income limits for someone who contributes. Anyone's going to be eligible. It doesn't matter what tax bracket you're in, what deductions or credits you're allowed to get. Any type of person, whether you make $5,000, $50,000, or $500,000 a year, it's all the same. You can all contribute to a 529. And something that tends to get overlooked with 529 plans are the estate planning benefits that clients have access to. A lot of high income earners, and really any earner for that matter, can take advantage of getting assets out of a taxable estate, wealth transfer opportunities, different gifting strategies. There are really a handful of different aspects of a 529 where estate planning, a 529 can play a big role in someone's estate planning component of their financial plan. So to give you a few examples of that, money going into a 529 is considered a completed present interest gift. And something unique to 529 plans is what's known as a 5-year accelerated gift. So this is where you do 5 years worth of gifting in 1 year. So as an individual, you can put up to $90,000 as of 2024 into a 529. And as a couple, you can put up to $180,000 that you can gift to one beneficiary. And you can do this, by the way, over multiple beneficiaries within the same year without incurring any sort of gift taxes or estate taxes or anything like that. It's really just an extra check the box on a tax form just to acknowledge that you're making it a 5-year gift. The biggest benefit here, you're putting in a lot more money sooner, so it can grow tax deferred a lot faster compared to if you did the annual gift every year over the course of the next 5 years. A 529, a gift going in there is immediately removed from a donor's taxable estate. If you do the 5-year gift, you have to wait the full 5 years to have it fully removed. It's averaged out. But you can also access this money whenever you need it. So 529 assets are completely revocable. If you need to pull the assets back into your name as the account owner and use it for something else, let's say you overfunded the account, or you want to buy a vacation home, or maybe the child doesn't go to school anymore, unexpected financial hardship, whatever it might be, you can pull that money back out and you'll never be taxed or penalized on the principal portion coming out of a 529 plan, only the earnings portion. But again, that principal is always something you have access to if you need it. So this next chart is a great example of this. I won't go over this in too much detail, and please don't marry yourselves to any of the numbers up here on the screen. But this is a great example of some of the estate planning benefits and what you can do with a 529 and 5-year gifting. So Susan and Howard are a grandparent couple. They did that 5-year accelerated gift, the full amount, for each of their 5 grandkids, Jordan, Lisa, Drew, Mike, and Tracy. Again, this is all happening in 1 year. So over the course of the next 5 years, that $900,000 they put in is removed from their taxable estate. But as the account holders, Susan and Howard maintain control of these assets. We'll assume that they are the owners for each of these 529 plans. They maintain control. The assets are revocable if they need it at any point. And it doesn't matter how old any of these grandkids are. Susan and Howard don't give up control when they reach age of majority, unlike an UGMA or UPMA account, for example, or even certain types of trusts. So great level of flexibility to have. You maintain control of the assets. They're removed from your taxable estate. You're in control of how they're distributed, and you can pull them back into your estate if you need them for something else. So a ton of flexibility there when it comes to estate planning, and something that not a lot of people really think about when they set up 529s. So, and also in the same year, Adam and Melanie did the same gift for their 3 kids, Jennifer and Tim, the same gift for Mike and Tracy. So this can all happen in 1 year from multiple different sources, and nobody here has to deal with any sort of unnecessary gift tax or estate taxes. This is just a really good way to get an early high account starting balance of a 529 plan. So question 7, you'll lose your savings if your child doesn't go to college, true or false? Thankfully, the answer to this is false. So the most common thing people do, like I said, transfer assets to another family member of the current beneficiary. Your worst case scenario, if there is a, you get a full scholarship, for example, or the child just doesn't decide to go to school at all, you just deal with the repercussions of taking a non-qualified distribution, which means that you pay ordinary income taxes on the earnings portion coming out of the plan, and then a 10% penalty on that earnings portion as well. All money always comes out pro rata. So whatever setup you have with contribution to earnings currently in there, that will be reflected in the distribution you take. You can't pick and choose between contribution and earnings. So that's something to be mindful of, but there's never going to be a tax or penalty on the withdrawals from the principal portion. That is the most important thing to know. But again, you're getting years of tax deferred growth. A lot of the times that will make up for, that 10% penalty and even some of the ordinary income taxes. Question 8, anyone can contribute to a 529, true or false? And the answer to this, for the first time in this entire presentation, is true. 529s are a great crowdfunding vehicle when it comes to paying for education. Anyone can contribute to a 529. You don't have to have a relationship with the account owner or the current beneficiary. And a lot of people will start to give, instead of, tchotchke Christmas gifts or Hanukkah gifts, holiday gifts, whatever you're celebrating, birthday gifts, instead of giving a cheap toy, they will contribute and help fund a 529, make a contribution slip or a donation to someone's 529 plan, which is a much more meaningful gift. But anyone in sum can contribute to any other person's 529 plan. Question 9, savings in a 529 plan dramatically reduces financial aid eligibility, true or false? Thankfully, when it comes to 529s, they have a very small impact on federal aid eligibility. You see this chart up here, which we don't need to get in the weeds on for the sake of this presentation. But all you really need to know is that a parent-owned 529, only about just over 5% of those assets is factored into the federal aid equation at all. And that is pretty minute for most people. Simply put, if you have $100,000 in a parent-owned 529, only about $5,000 will go against federal aid eligibility. Most people price themselves out of federal aid simply when it comes to their income. So for the sake of a 529 plan, there's really not a big impact that you have to worry about at all. It's not looked at as income towards anyone, whether it's the students or the parents, and it's looked at a parent asset, not as a student asset. So great thing there. You should never not save in a 529 plan for the sake of potentially hurting federal aid down the road. That is not a good financial strategy to work with. Question 10, if your child wins a full scholarship, you pay a penalty on withdrawals from 529 savings plans, true or false? So basically, what do you do if you get scholarship money? So if you get scholarship money, what's a cool thing about 529s, you can take up to that scholarship amount out of the 529 plan and avoid the 10% penalty on the earnings as a non-qualified distribution. So if you have $50,000 in scholarships over 4 years, you can take up to $50,000 out of that 529 plan. You will only be taxed on the earnings portion coming out of that 529. That is it. You don't have to deal with that 10% penalty. So in essence, it almost works like a brokerage account if you're taking money out because of scholarships. But unfortunately, full rides are just not a common thing. Less than 1% of all children across the US get any sort of full ride. And even when they do, a lot of times there are expenses that are not going to be covered, whether it is, room and board or textbooks, dining hall plans, whatever it might be. So some things to think about: if you have leftover money in a 529 plan, you can use some of the money to pay off student loans. You can use now up to $35,000 to pay to transfer into a Roth IRA from a 529 under certain conditions. That is a penalty-free and tax-free type of transfer. You can save the money and use it for a later degree, maybe a doctorate or some sort of post-grad degree. You can change it to another beneficiary, or you can just let the money grow tax-deferred over time. And a lot of the times, after another 10, 20 years of tax-deferred growth, that 10% penalty is really not going to be that big of a deal because you're getting so much tax-deferred growth over that time. So overfunding a 529 is a good problem to have, in my opinion, and not something that should be frowned upon. There are a lot of things you can do with leftover money. So with that being said, I'm pretty much coming up on time here, and I wanted to open things up for everyone to go over a little bit of Q&A. So please, if there are any questions, feel free to fire away. And Dean, Krista, and everybody else, thanks for having me on. And if there's anything else I can do to help, please let me know.
Thank you, Stephen. It looks like maybe Lonnie here has a question for you. So Lonnie, if you feel free to unmute yourself, please ask away any questions you might have directly to Stephen, and we can get that question answered. And I do have a couple additional questions from the chat, so please feel free to address your question first, Alana.
Thanks. Hi, Stephen. I just wanted to ask a question about, you said in limited circumstances you can roll, I think you said 35,000 into a Roth if it's unused. What would those circumstances be?
Yeah, so unfortunately,
Thanks.
the government, yeah, of course. And nice to meet you, by the way. And unfortunately, the government did have some interesting stipulations around moving money from a 529 to a Roth. So it's a great idea because it kind of gives you a cushion if you have leftover money. But some of the stipulations include: one, the account needs to be open for at least 15 years and in the same beneficiary's name for those 15 years. You can change plans, you can change account owners, but you have to have the same beneficiary for those 15 years. The second one being, you can roll up to $35,000, but you're limited to basically the Roth IRA contribution limit per year. So right now that's $7,000. If that stays the same for the next 5 years, you can do $7,000 a year for 5 years until you hit that $35,000. During that time, when you're doing a $7,000 a year, you also have to have at least $7,000 in earned income. So in that regard, just like if you're contributing normally to a Roth IRA, you need earned income, you have to have earned income for this rollover as well. But for whatever reason, income limits don't apply. So you can make $1 million and still do this type of rollover. You can't use any money in the 529 plan that is not at least 5 years old. So when you do the rollover, basically you look back at the account balance 5 years ago, and whatever that amount is, you can roll up to that amount over as long as it's, 30. If you want to do the full $35,000, of course, then you want that number to be at least 35,000 in theory. But technically that resets every year because you're only doing 7,000 a year. So you kind of have to keep track of that a little bit. But for most people, I don't think it will be an issue, especially if the account's been open and funded for a long time. But it's just one of those nuanced things that you kind of just have to think about. So that's some of the stipulations. I honestly don't know how the government's going to track a lot of that stuff. So it's just something you need to be aware of. But that's a good question to ask.
Stephen, a follow-up question to that. Does that also prohibit you from making a contribution directly to Roth IRA, or can you do that in addition to making contributions to Roth IRA?
Good question, Dean. Unfortunately, you can't do it in addition. It's basically being looked at as this is your contribution, even though it's a rollover. So you can't double dip in that sense, unfortunately.
Very good. One of the questions from the chat was actually that Roth provision that came out via the Secure Act, which Lonnie had addressed. But an additional question, is there any changes to the FAFSA reporting that clients should be made aware of that came about because of the Secure Act? Is there any big things out there that changed as far as planning is concerned? I know that grandparental assets now have changed, and whether or not they should be included in the FAFSA. And I have a lot of clients that ask, should we open the 529 in our name, or would it be more beneficial to open it up in the grandparents' name to help with their estate planning needs? So if you could just comment on that and just broadly touch base as to what you're seeing a lot of clients do, that would be wonderful.
Yeah, of course. So there were a handful of changes to FAFSA for this year. So if anyone's filled out that form for them or their kids or their clients, it's definitely different than it's been in past years. It is technically separate from Secure Act, but the timing is the same. So, FAFSA is a lot shorter now. Expected family contribution is now called the Student Aid Index. But one of the bigger changes that specifically relates to, parent-owned versus grandparent-owned 529s or non-parent-owned 529s. So what that's a grandparent, aunt, uncle, cousin, in-law, whoever it might be. There were some changes. So going forward, and as it stands today in 2024, a parent-owned 529, we talked about this in the presentation, has about a 5.6% impact from assets. And then any distributions are not looked at as income towards anyone, whether it's the student or the parents, which is a good thing because that is where you tend to have the biggest impact. When it comes to grandparent or non-parent owned 529s, this was a good change because going forward, there's no impact on federal aid eligibility whatsoever, whether it's on the asset side or the distribution side being looked at as income. Whereas in the past, it was looked at as income towards the child after a 2-year look back period. So for example, if you had like a grandparent on 529, the first 2 years, like a freshman, sophomore year, if you're drawing down from it, there's no impact. But your junior, senior year, those drawdowns will be looked at as income towards the child for the standpoint of federal aid in particular. So you no longer have to worry about that going forward, which is nice. So on a technical level, from parent-owned 529 will not have, or a non-parent-owned 529 will not have any impact on federal aid eligibility. Whereas a parent-owned 529 just has that 5.64% on assets. Now, I wouldn't say you need to bend over backwards to find someone else besides the parent to own the 529, because that 5.64% really only matters if you're even eligible for federal aid to begin with. So for a lot of people, it's like you shouldn't jump through hoops. But if you have a setup where, the grandparent or the parent could own the 529 and it doesn't make a difference, then yeah, technically a grandparent or non-parent on 529 won't have that impact. But I would just keep in mind there are other implications to 529 ownership. Whoever owns the 529 has complete control over how it's distributed and what investments it's in. So again, on technical level, grandparent, non-parent on 529 has no impact, but that shouldn't stop you from setting up a parent on 529 if that's the only option you have.
Very good. We'll leave the line open for another few minutes here, but Stephen, I wanted to just say thank you again for joining us today. We went through a lot of information. Partnering with firms like John Hancock for this type of presentation is what really makes us different here at Flagship. Being an independent and being able to partner with multiple fund companies is a great thing. And Stephen and his team are great great partner for us here. And Steve, we can't thank you enough. So thank you very much for today.
Of course. Again, thank you for having me. It's always a pleasure to do these. And, we appreciate the continued support in our 529 plan that you and the team provide us. So if there's anything more we can be doing, let us know. And again, I'm always happy to come on and even speak with clients directly, with of course you there, if you want to get really specific and then talk about that and certain meetings you have with clients. So happy to help and just let me know what we can do.
We appreciate it, Steve. Thank you all for joining us, and we will wrap up now. So thanks again, guys. Have a great rest of your week, and enjoy the start of summer here. Take care, guys.
Yeah. Take care. You as well.